Hello everyone, this is Marshall Gittler speaking. I'm going to discuss the main issues facing the FX market in the coming week beginning the 19th of February. Well, it's been a brutal week for the dollar. The US currency fell the most in about 2 years. What's special about this week, or the last week, is that the dollar fell even though US Treasury yields rose more than yields in most other countries. As you can see, this graph shows the change in the U.S. Treasury yield, 10-year yields relative to other markets. You can see how the spread widened in favor of Treasuries for most markets. Normally, that would tend to support the dollar, but it didn't help at all this week. Now, the move was especially noticeable when we look at dollar-yen. The yen is the most sensitive currency to higher U.S. Treasury yields because the Bank of Japan is pegging the Japanese 10-year yield. They're keeping it at zero, more or less. That means when U.S. Treasury yields rise, the spread between U.S. and Japanese yields widens 1-for-1. Now, other countries' bonds are often influenced by what happens with the U.S. Treasury yields and sometimes move in the same direction, sort of pulled by the Treasury market's gravity. That reduces the impact of the move in U.S. Treasuries on the spread and therefore on the currency, but not with the yen. As you can see in this graph, where the green line is the differential between 10-year yields and the purple line is dollar-yen, they've been going their opposite direction. Now, even though U.S. yields are rising relative to Japanese yields, what we've seen is Japanese investors selling foreign bonds. That's this green line here, which shows the Japanese purchases or sales, for a negative figure, of foreign bonds. That shows, I think, a lack of confidence in U.S. markets. Now, what might be causing that? I think it's the return of the twin deficits. This refers to the U.S. government budget deficit, the green line in this graph, and the current account deficit, the purple line. This graph shows both of them as a percentage of U.S. GDP. The red line is the sum of those two, and that is the twin deficit. Now here we have the twin deficit versus the Fed's index of the value of the dollar against the U.S. major trading partners. You can see two things from this graph. First off, the value of the dollar does tend to broadly track the twin deficits over time. I mean, it's not 1-for-1, but over time they tend to move in the same direction. Secondly, if you look at the end of the twin deficits line, the red line, you'll notice that it extends out past the current period. That's calculated using the OECD's forecast for the U.S. budget deficit and the market's forecast for the U.S. current account deficit. What you can see is it's expected to worsen. And probably that forecast for the budget deficit didn't even include the impact of the latest budget bill in Washington, which will cause the deficit to explode even further. I think that really was the trigger for bringing this into everybody's attention. Now, it's clear that that budget deficit has totally disappeared. It's clear that budget deficit has totally disappeared in the U.S. Moreover, the trade deficit is widening despite the efforts of the administration to rectify it. The trade deficit, excluding petroleum, recently hit a record high. That's making people think that the U.S. dollar's long upcycle, which began in 2008, really did come to an end in 2016. There was some debate whether this was just a counter-cyclical down move within the long upwards trend. You can see in this graph how even when the dollar is in a long-term trend one way or the other, that's the purple line that shows the dollar's move, there are often other long periods, highlighted in green here, where the currency moves in the opposite direction of the long-term trend. I think there had been some debate about whether the recent move in the dollar was just one of those counter-cyclical periods, but more and more people are thinking that with the twin deficits coming back into focus, it's the start of a new down wave. And I think that is likely to keep the dollar under pressure until and unless we see the Fed start hiking rates more aggressively than people are already thinking, which is another matter. As for the indicators this week, the main ones will be the preliminary purchasing managers indices for the major economies. They're generally expected to be slightly weaker, but they're still expected to show a healthy expansion for these major economies. As you can see from this graph, which shows last month's purchasing managers indices against the change on the PMIs over the last 3 months, most of the PMIs are in the first quadrant, the upper right-hand corner, which that shows an accelerating pace of expansion. I think that's going to underpin the outlook for the global economy and should be good for stocks in my view. So I think a risk-on scenario is likely to be the scenario next week. That may help to bring back carry trades. Along with the PMIs, we also get the ZEW and IFO surveys for Germany, which are somewhat similar indicators. As for Britain, we've got a number of important events this week, including testimony to Parliament by Bank of England Governor Carney and several of his colleagues. The UK indicators out include public sector borrowing, the second estimate of fourth quarter GDP, and perhaps the key, the employment data. The unemployment rate is expected to stay at the current low level, but importantly, the change of the number of new jobs is forecast to rise sharply. That's the green bar and the green dot on the left-hand graph. Wage growth, though, is expected to remain at the current pace. That's the graph on the right-hand side, so no acceleration expected there. The news may support the pound, I think the rise in employment growth is positive, but I don't think it's enough to change anyone's estimates. Elsewhere, we get the CPI reports from Canada and Japan, plus we get the minutes of the Fed's January meeting. That may give us some hints about what the Fed's likely to do at their meeting in March. Now, for this week, I expect to see the following. I think the dollar is likely to weaken further. Why? Well, it just seems to be the trend. If the CPI the higher than expected CPI didn't support the dollar, I don't know what's likely to, but I can see things that will push it down. The euro and the yen, especially the yen, are likely to strengthen as a result. Now, this is just the counterpart to dollar weakness. The yen could be restrained somewhat in a risk-on scenario that I'm expecting, but what we've seen just in the last couple of days is that a higher stock market is no barrier to a lower dollar yen, a stronger yen. Usually dollar yen and stock markets move in tandem, but that correlation seems to have broken down recently. I think the yen can continue to strengthen, i.e. dollar yen can continue to move down even if stocks move higher. Sterling, an interesting story there as always. It's while the economic news may support the pound, as always, it's really at the mercy of the Brexit news. Now, EU and UK officials will hold some technical discussions during the week concerning the implementation period and the thorny question of the Irish border. It's impossible to say what might come out of those talks, but my impression is that the news usually isn't good, particularly at the beginning of a negotiation period such as now. This is Marshall Gittler bringing you the outlook for the week beginning the 19th of February. Thank you for listening and good luck with your trading.